Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Just getting our topics in order here. We got some great ones today. First one, why I won't be buying, or we won't be buying Palantir Technologies anytime soon. I know it's a hot stock. We'll talk about that so you understand the details of that. Another one that, and this is not a buy recommendation, but Apple stock continues to amaze us. We'll talk about why that is, but it's not a good thing, to be honest with you here. And then lastly, good news, only 26% of big money managers are bullish. You might be scratching your head. Why is that bullish? Why is that good? We'll tell you why it's good. We'll talk more about it. With that, Chase, what companies are we taking on today?
Yeah, companies we're going to look at here. Scott's Miracle-Gro. I know you kind of like their products. I think you use some of them. I don't know if I use them.
I don't use them. My gardener uses them.
Yeah.
I think everybody uses them.
Yeah, probably. You're right. The other ones we'll look at here, too, as well, includes, it used to be Square, but now it's Block. And then we'll look at Amazon. And lastly, McDonald's. So got some great companies here. Going to see if it's a buy, sell, or hold based off, again, the numbers that we see here on air.
Do we have any Big Macs for product placement when we're doing? I'm kind of hungry.
I prefer the quarter pounder, honestly, but you know, I used to take down some quarter pounders back in the day, but not anymore.
Not anymore. Well, we'll talk about the stock side, not the food side. Let's talk about why we won't be buying Palantir. Did I ever say it?
Palantir.
Palantir. I say it differently every time. Palantir Technologies. Anytime soon. Now, I believe I'm asked about this company probably more than any company right now, because investors, they look at the hype of this company and the past performance, and got to give it credit. You know, the stock is up 1,000% since going public just about 5 years ago. So if you bought it, congratulations. But again, we invest in companies, businesses. We don't invest in the hype. And what this is doing is it's creating a lot of hype for people thinking, wow, it's up 1,000%. It'll be up 2,000%. I better buy it now before I miss it. And this is creating the excitement for investors that I think is a big mistake. And this is why investors don't do well.
Yeah, and I mean, you talk about since inception, or since 2020 when they went public. I mean, gosh, over the last 1 year, I want to look at this. It's up 461%.
Oh, just 1 year? Wow.
1 year. Year to date, in a difficult stock market, it came back down, and then it's like, oh, everybody got back into the hype again, and now it's up like 55%. Year to date. I mean, this stock is just crazy. It kind of reminds me a little bit of GameStop, to be quite honest. And the retail crowd that continues to push it higher. And I bring up GameStop because it made no sense. And I'm going to tell you, Palantir, the business is much better than GameStop's. It's actually a growing business. It has sales. It has earnings. But the hype behind it is just crazy. If you look at the valuations, it currently trades around 60 times next year's sales.
Not earnings.
Not earnings.
Yeah.
Sales. That makes it the most expensive stock in the entire S&P 500. I mean, we talk about historically stocks trade around 16, 17 times earnings. Not 60 times sales. I mean, that is just ludicrous. It's 163 times next year's earnings is what it trades at currently.
And I think, again, just to reiterate, you talked about the most expensive stock in the entire S&P 500.
Yeah, and I was blown away by this. It is actually now the 10th largest technology company in the S&P 500.
Wow. Well,
it just surpassed Salesforce, which is 10 times bigger in terms of revenue. Earlier, it passed Cisco, IBM. I mean, this company is, I think, just too far ahead of itself. I think, again, it's a good business. I think it's growing well, but the valuations, it's just, they're crazy.
Well, let's talk about the business itself, because there are signs that growth outside the U.S. is slowing. And what really bothers me in this company is I don't like the fact that they have 3 unnamed companies, and these account for almost 20%, 17% of the revenue. And this is just very dangerous, because who are those companies? They could be a company that, one, could be ready to file bankruptcy. They could be looking at somebody else. I mean, it's just, and I got a question. Why are they unnamed? I feel like they're trying to hide something here.
Yeah, and I don't really know what they do. I know it's like AI and technology, and it's supposed to help business and help the government as well become more efficient, which I'm all for. I mean,
for that,
if it actually helps businesses become more efficient, I think it's a great tool. But the issue, as you said, is not having that clarity for close to 20% of your revenue. That could take down, especially a stock that is supposed to be growing. You lose, let's say, 8% of your revenue just to make it easy. Well, now all of a sudden you're not growing revenue anymore. You can't justify trading at 60 times sales. I mean, that's a big problem there. And it reminds me too, I mean, of a company called Snowflake. And in 2021, that stock hit over $400 per share. It was part of the software craze, it's SaaS, software as a service is what that's known as. But today that stock is down nearly 60% and trades around $174 per share.
And you don't hear much about that stock now. But I remember, because back in 2021, I remember people saying, "Oh, Snowflake, should we get that?" Same thing I'm hearing now with Palantir, and that's why again you bring that up is because these hot stocks they're hot for a while and nothing else happens with them, and I just kind of worry. And I do want to mention, and we'll talk about Apple, something different. But I remember in the past, if you had Apple as a customer, as a client, you were very worried because they could take their business somewhere else. And that's why when we talk about we don't know who those unnamed companies are, you need to know, because what if it is an Apple or like an Apple to where they could leave it tomorrow and they leave Palantir, in the wind. I mean, it's terrible.
Yeah, and I again want to be clear. I think this business, I made the comment about GameStop. I just want to clarify. I do think this is a good business. I think there's interest there. I think their technology is good, and I'm not a tech guy, so I can't fully vouch for that. But I mean, it appears that businesses like their technology because the numbers are good. The sales are growing, their earnings are growing. They have earnings, so it's they're not losing money. It's just so expensive.
And we always look at the management team. Who's the management team? And I gotta say, Alex Karp, who's the CEO, he's kind of like a loose cannon. Yeah. And I say that because in an interview just a few months ago, he had some pretty nasty comments about analysts and who don't agree with him on the price stock. And this is, I quote, this is what he said, quote unquote, "I love the idea of getting a drone and having light fentanyl-laced urine spraying on analysts who've tried to screw us." What CEO says that as is in a right mind? I mean, that is just ludicrous. We got to be careful. We got to look above because now we're saying bad things. We could have drones flying over us now, but I've just, in my 40 plus years of doing this, I've never heard a CEO do anything so crazy. Not even Elon Musk.
And I think it is so wrong because the analysts aren't trying to screw you. They're not trying to destroy your business. They're just saying the stock's expensive. Yeah. I mean, you can't deny that. What is it? Do you think Palantir is the most valuable company in the world? Do you think it is going to now all of a sudden be worth more than Apple? Is it just going to continue to climb higher and higher? If you think the stock price is only going to go up, I mean, is that what he's looking at? Is somebody screwing his business? I think it's wrong, and I think for him to say something to that magnitude is just crazy. And you brought up Elon Musk. I was going to say I've talked about GameStop.
Right.
I think he's trying to be like Elon Musk. I think he's trying to be like Tesla. I think he's trying to be so outlandish that you create that kind of stock hype that we've seen with Tesla. And who knows, maybe they accomplish it and it continues to go higher, but I think it's already kind of gone so far.
I don't think Elon Musk, I mean, he said some outlandish things, but I don't think he's ever said anything that bad against analysts who, again, they're just trying to do their job. Everybody has their own opinion. You can't attack people just because that's their opinion based on their analysis. And he does look like a mad scientist. He's got that crazy haircut and everything, or hairstyle, I guess I'll call it. But it's just something that we're just warning people, be careful. Very hyped company. And could it take the path of Snowflake? We don't know, but be careful.
Is it another meme stock? I mean, I think it's, again, you look at a chart of it, it goes like this, and I mean, it's the next move. Back down.
And we, again, have to be careful of drones flying over us.
Yeah.
We're now on the bad side. Let's talk about Apple, because this stock just continues to amaze us here. We all know about the tariffs and the delayed AI rollout that Apple had, but I was definitely concerned by a couple of announcements that, well, they would have large impacts on Apple's service revenue, and these are major ones.
Yeah, I mean, they're huge. And the thing you look at the service business is that has been kind of the crown jewel, so to speak, of Apple, where it's like, well, they're not just iPhone anymore, even though iPhone, I think, still accounts for about half their sales. I think so. They're not just iPad. They have this service revenue, which is growing tremendously. It's reoccurring revenue. It's great. But a big problem was actually in the most recent quarter, they didn't miss expectations, and the service revenue grew at just 11.6% compared to last year. And I say just, I mean, that's a decent growth rate, but, we'll kind of get to the valuations on Apple. I would be expecting more growth from that business if you're going to justify a higher multiple.
And people might think, oh, they hate Apple and so forth. No, I just bought an Apple Watch. We love the company. We just are concerned for investors. It's overpriced, which brings me to the next big concern we have that I don't think a lot of people know this, but Alphabet has an estimated payment of around $20 billion annually to be the default search engine. I mean, and that's a lot of money. There is concern if this were to hold up in the court ruling that they're going through. Apple's in court right now. It's monopoly. And
not Alphabet in court right now.
Well, actually, Apple is too.
Yeah, they're in the court too, yeah.
But we are talking about Alphabet in the court about being a monopoly. And this is a big problem because also this week, Apple executive Eddie Q added additional concerns. I can't believe he came out and said this, but I guess he's talking the truth. He stated the searches in the Apple Safari browser fell for the first time in April, something that has never happened in 20 years. That's huge. He then added that the iPhone maker, kind of looking at adding AI search options to the Safari browser. So competition there. Alphabet, that's the problem. Alphabet, Apple. I wish it was close. Google. Google would be so much easier. But just like saying, yeah, you know what? Maybe we're not going to pay you $20 billion.
Well, and the big thing on that $20 billion is that almost flows directly through to the bottom line.
Yeah.
I mean, I can't imagine there's many, if any, costs associated with that. So not only, let's say they lose that $20 billion in revenue, that'd be a direct loss, essentially, of $20 billion in profit, which would hurt. The other thing you look at here as well with this payment, as you said, I mean, if you're like, you can still be the default search browser, but we're also going to give people the option of maybe pulling in ChatGPT. They talked a lot about Perplexity as well. Eddie Q did. They seem to like Perplexity quite a bit. Why would I pay you $20 billion if people aren't going to be using my search engine because they're going to click on ChatGPT instead? That makes no sense. I mean, that is a huge risk to $20 billion in my viewpoint.
And I don't know what the free cash flow is for Apple, but I would say this is a big part of it, $20 billion. And I don't know if they pay it monthly, yearly, quarterly, how they pay it, but it's still, as you said, there's really no expenses to it. It's just free cash flow coming in.
Yep.
And if they were to lose half of that, I think that'd be a big loss.
Yeah, and I mean, maybe there'd be other people that would be willing to pay for that, but if it's not the exclusivity of having that default search, I don't think it's nearly as valuable.
Yeah.
I mean, there's some big question marks that they'll have to answer there. And that $20 billion is supposedly tied into that service revenue. So you could see that service revenue shrink quite quickly. The other thing, too, that we look at is that there was actually a recent ruling, and I was surprised this didn't get much attention, it appeared. But a judge ordered Apple to immediately stop imposing commissions on purchases made for iPhone apps through web links inside its apps. This has enabled developers like Amazon and Spotify to update their apps to avoid Apple's commissions and direct customers to their own website for payments. This commission rate was around 27% for Apple, and it could cost them billions of dollars annually. I don't know where people just didn't want to talk about this, that's huge to me. That this service side, again, almost another thing where I don't think they're doing very much, but they're charging this 27% commission. Yeah. And if you actually look at commission rates just on the App Store, I guess it ranges between 15 and 30% generally. But they initially allowed for like web links. So if a company wanted to go in, like let's use Amazon's Kindle, for example, and they wanted to say, well, you can buy the book, just click the link here and go to Amazon to purchase it. Well, that's where that 27% commission would be charged. Well, now you don't get that 27% commission.
And what we're trying to do here is that because people do this as investors all the time. You buy something, it's Apple, it's going to come back. Oh, everybody's got an Apple. Oh, it's a great company. But there's things that are developing underneath or behind the curtain, so to speak, that could cause problems down the road. And also in the stock, again, I've been on there, I think you've been on there, saying this stock could drop easily 30, 40% because there's just no reason for it. People say, that will never happen. That's Apple. But again, when you look at it right now, it trades at 25 times 2026 earnings. And even though revenue is only estimated to grow in the low, mid-single digits. I mean, this is not a great growth company. I mean, I think some of these energy companies have higher growth than Apple does with lower PEs, and you're paying a lot less for them. So Apple, again, great company. Tim Cook, great CEO. Love their products. But this has been pushed too high, not too fast. It's been kind of developing. I know we've talked about this before. I think there was 2012, a big drop on the stock. So we're warning you, if you have Apple, just kind of hear what we're saying, because if it does drop 30, 40%, I don't know what Apple can do, Tim Cook can do to change this. You're going to say, whoa, what happened? Oh, shoot, that was on the Smart Investing Show back in May. I should have listened.
Well, I know we take flack from people saying, well, you said Apple was expensive a few years ago, and it was.
It was.
It just got more expensive. It's the only problem. And that's the issue with having a strategy and sticking to a discipline is you're wrong sometimes.
Yeah.
But I tell people I'd always rather be wrong for the right reasons than right for the wrong reasons, because that then could lead you to make big mistakes by kind of being like, oh, well, it's Apple, it'll never fall. Again, we talk about how GE had that same perception years ago, and people are like, I saw that coming. No, you didn't. No. And I guarantee you 5 years from now, if Apple does fall, people will be like, I knew that was going to happen. Well, then why didn't you sell your Apple stock?
Right.
So I just, again, I think it is one of the stocks that amazes me for the wrong reasons.
For the wrong reasons. And it's one that actually we look at. And again, we talk about buying and investing in businesses for the right price. And again, Apple, great company. It's just too pricey. And it's just, and we continue, when we find things, we'll share them with you. If you want to act on it, that's great. If not, well, we did our best. Yeah. So let's talk about some good news here. I say that with in quotes. Only 26% of big money managers are bullish. Now, this is a recent poll that came from Barron's Magazine, which they conduct twice a year, spring and fall. The spring one just came out. They found that only 26% of big money managers were bullish and thought that stocks would go up, while 74%, almost 3/4, were either neutral or bearish on stocks. That sounds like bad news. We're going to give you the excitement a little bit later on here.
Yeah, a little bit later on, because just kind of looking more at some of the details of that. In fact, 32% of respondents were bearish, and that was the highest percent since 1997, while the 26% that were bullish marked the lowest reading since 1997. So money managers are a little bit nervous here, and I do think it is interesting how nervous they are, considering the hype that continues to climb in the retail side of the markets, I'm going to say.
And actually, 1997, you think about it, like, wow, that's nearly 30 years. I know we just did a post, or I think we did a post. We didn't, again, a newsletter, we're not covering it here, but we talked about 30-year performance. It seems like it's so long ago. Yeah. But actually, 1997, 28 years ago. Yeah. And again, that's some big news there. But the last big negative in the economy and the market was in 2008, the Great Recession. That was 17 years ago. A current manager that graduated from school at age 23, he would now be about 40 years old, but he did not experience going through 2008. Now, living through and managing money through a challenge like that, provided myself, when I went through it, it was very difficult, with extremely valuable lessons that younger managers, they just won't understand. And that could be why. And I was a little bit disappointed in the survey that Barron's didn't say the experience level. And I guess I don't think they ever do that. But your money managers are probably on average 40 to 50 is my guess.
Yeah, no, I think you're probably right. I mean, there are a lot that are older, and you're not out there swinging a hammer or doing anything crazy, so you can kind of do it longer. Obviously, we talk about Warren Buffett being in his 90s, still managing money, not necessarily directly for people, but
right.
Still looking at investing. So it is a career path that you can do longer than other jobs. So I would be interested, as you said, to know what the demographics were for that survey. But now to the true point of this post, I'm going to say, why is it positive that only 26% of big money managers were bullish? I'm going to say potentially positive, because I have a little bit of a conflicting viewpoint here. But what we look at is the current asset allocation is only 64% in equities, with 36% in other investments like fixed income and cash. So the thing is, could that all of a sudden switch, and now all of a sudden people are more bullish? Now you need to find places to put that fixed income and cash, which can then lift stocks down the road, in theory.
And when I kind of look at 64% equities is pretty low. And if they just shift and say, you know what, let's start add to it and just add 10%, bring up to 74%. Yeah. That's going to be a big move, a lot of buying in the market that can really help the market. And what I also like to, if you're looking for value, now the least attractive sectors that these big money managers said was energy, which I think it's a great one. And again, we are looking longer term. We look 12, 24 months down the road. Real estate, another one that I think is great on sale. Utilities. We were looking at utility, but it kind of rebounded somewhat. But I think there could be something there with the growth of the energy down the road. So that's the thing, too. The survey didn't really say what their time horizon is. I think in the next 3-4 months, yeah, okay. But when we invest, you should be investing for the longer term, which these money managers should as well, unless they're day traders.
Yeah, and I was just going to say real quick, I do agree with the money managers, though. And
What do you agree with?
The fact that they aren't, I mean, this is pretty close to what we have for some of our clients. We're about 80% cash, invested, about 20% cash, which is higher than most times. I just really think the retail crowd has gotten so crazy. Right. And I think they could be right here because while, it's a bullish indicator, I do also worry that you talk about Bitcoin above 100,000, you talk about Palantir. I mean, you talk about these risky places in the market. There's a reason why these money managers, including ourselves, we're more bearish than we have been in the past because valuations are crazy. I mean, you talk about the market now, it's rebounded to a point, again, being over 21 times future earnings. That's not a place where I would be bullish. So you get that rebound in the market even further. What are we going to trade at 24 times future earnings? I think there are definitely some truths to the survey and definitely some agreeable points as to why I am more bearish than I have been in the past. Yeah,
I'm more bearish, but I think 64% is pretty low.
I agree with that.
I mean, even during 2008, I didn't go that low. Yeah. I think we were 70% had a hedge against it, but 64% is pretty low. Which again, they just bring it up 10%. Oh, that's going to be a lot of buying in the market. And then also too, you got to talk about the
I was going to talk about too. One other area we agree with him on is the Mag 7.
Yeah,
and this is one thing that only 10% of these managers think the Mag 7 will lead the market over the next 6 months, and even looking out 12 months, only climbed to 32% thought that group would lead the market. So I don't even think I think 32% is high. I thought it'd be even lower. I mean, the Mag 7 is just so expensive, and I really think that the reason we have more invested in equities than, again, that 64% threshold is because I think there is still value in the market. But the retail crowd has gotten too into these hype stocks. That's where I think a lot of the concern is.
And actually, when they asked about the strength of the U.S. dollar going forward, 12 months, 68% of money managers said, it'll be weaker, which we do agree with that. And only 15% thought it'd be stronger. We do think that the dollar will be weaker, and that's a good thing for our trade. So this information all comes from our newsletter. Goes out every Friday at 5 o'clock. Other topics that we did not have time to discuss today that you can get by going to our website, smartinvesting2000.com. That's smartinvesting2000.com. People claiming early Social Security is up 16%. High-end companies with luxury items, well, they have a problem. Hostile stocks, well, could be on sale. America's top CEOs get paid a lot. We'll talk about that. What will college graduates face when they graduate in a few weeks? And stocks receive little love as a great place to invest. Go to our website again, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the free newsletter. It goes out every Friday by email at 5 o'clock. Enjoy it and sign up. Let's talk about, move on to companies here. A little bit pressed for time, but we want to talk about Scotts Miracle-Gro. And this is just a company that I saw and I liked, wow, everybody I think knows this company. So let's talk about the company a little bit here and give you the symbol. It's SMG. They're in the agricultural input industry. 7.6% shares are short on the float side, 73% institutional owned. PE ratio, not a good start here. It's 92.9 versus 29.9. Price to sales looks good, 0.9 versus 1.2. No price to book value, which is not good. That means you take away all the liabilities from the assets. There's no equity there, which we don't like seeing that. Price to cash flow, 5.5 versus 8.4, and the no PEG ratio, so not happy on that. No earnings growth over the last year. Sales were up 3.8%, which was a positive versus a decline of 5.9% for the industry. Analysts don't like this. They say the 5-year earnings per share growth estimate is a negative 164. I don't get why that number is that strange. Does pay a 4.9% dividend, no earnings, so you can't give you a payout ratio on that. We do see the dividends have not really grown much over the past few years. Balance sheet, current ratio 1.9 versus 1.7. That's good. No debt to equity because there is no equity, so you can't have a debt to equity ratio there. We do see that the net profit margin checks in at a minus 0.7, so they lose almost 1% every sale they make. Industry's a positive 3.8, and return on equity is only 5 versus 3.9. Chase, what do you got?
And so current price here for the Scotts Miracle-Gro Company and their ticker symbol SMG, $53.99. It's fallen definitely from that 52-week high of $93.90. The low here is $45.61. Valuation looks pretty good on the business, though, going forward. You go out to September 2026, I see estimated earnings per share of $4.24. Actually gives a target sell price of $70.38, which is an estimated return of 30%. So it is actually right at our buy target there with that 30% margin of safety. But I got to say, I mean, no equity. I'd assume that debt is not pretty. I don't think you could justify buying a business like that, because sometimes we talk about franchise-based companies. We'll talk about McDonald's later on here. You kind of understand a little bit. They're asset light. I don't understand why Scotts Miracle-Gro would have no equity.
I don't either. And I just want to make a couple points before we run out of time here. About 25% of the business is in stores like Lowe's and Home Depot. They're very well known there. They also have brands like Ortho and distribute Roundup to consumers. They're in Maryland, Marysville, Ohio. Founded in 1868, so definitely an old company. But 4 years ago, the stock was about $252 a share. They got hammered because they invested in a cannabis marijuana company.
Surprising.
And they thought it's going to do great. I think they paid about $2 billion for it, and it became virtually worthless. So they had to write all that off, made no money.
That's why they have no equity.
That's why they have no equity. It was gone. And this is why, remember how hot cannabis was? Everybody wanted to be part of it. And that has really faded. And I just, it's a shame that a company like Scotts Miracle-Gro took that big risk on that.
You know, this is why you have to stay on top of your investments. I would never think it would make sense for a business like this to buy a cannabis company, but then all of a sudden you lost $2 billion worth of shareholders' value. I mean, I'm surprised the company doesn't get sued for that. That's a terrible investment decision.
Well, sometimes those lawsuits take years to develop, and I'm just looking now.
I was going to say, I mean, if they didn't do that, this might be a buy because you had $2 billion back to the balance sheet. I mean, that's could have created a positive equity there.
You know what their long-term debt is? 2.6 billion.
Wipe that away, you're probably fine. I mean, that is just ludicrous. They would have made that big of a mistake.
Crazy. All right, we'll take a quick break here. When we come back, we got going to be talking about Block, Amazon, McDonald's, and also, too, for financial planning, talking about breaking down retirement income taxation. Stay with us. You're listening to Smart Investing Show with Brent Chase. We'll be back. All righty. Welcome back to the second part of Smart Investing Show. This is where we talk about more companies, but also add the segment on financial planning. And for that, we have our CFP with Wilsey Asset Management, Harrison Johnson. Harrison, thanks for being with us today.
Always.
Talking about breaking down retirement income taxation. People hate taxes. What are we doing here?
People hate taxes. That's definitely true. So wanted to explain how different types of income in retirement are taxed, because when people are working, it's more common to have maybe just income coming from wages, maybe self-employment income. Usually, not always, but usually when you're working, there's not that many different types of income sources coming in. But in retirement, there can be a whole lot. So starting at the least attractive from a tax perspective, we have interest and annuity income. So any interest you get.
Annuity income.
Yeah. I mean, annuities, we can talk all day long about
we have
other ways that those are bad, but from a taxation level, they're also bad. So, but interest is another one. Interest is, something you might get from bonds. So if you think you need to get to retirement, be, quote unquote conservative and put bonds into your portfolio, just know that from a taxation level, they're taxed at a higher rate. So interest and annuity earnings, in this case, I'm talking about non-qualified annuities from a non-retirement account. The income is fully taxable on the federal level, fully taxable on the state level, all as ordinary income, and interest and annuity income can trigger net investment income depending on what income that you have. After that, if you have distributions from IRAs or pension income, that's taxable as ordinary income as well on the federal and state level, but those sources alone, IRA and pension income, will not trigger the net investment income tax. Next, we have rental income, also taxable on the federal and state level as ordinary income. But with rental income, you might have depreciation and things like that that can bring down your taxable income. So you have that benefit of depreciation. Next, we have capital gains and dividends. So if you buy stocks or equities, as we call them, the income comes in the form of capital gains and dividends, which are taxed at lower rates on the federal level. So ordinary income, you have your tax brackets of 10, 12, 22, 24, 32, 35, 37% tax brackets. Capital gains and dividends are taxed either at 0%, 15%, or maybe if your income is really high, then you could get pushed into the 20% bracket. But again, a much lower tax rate on capital gains and dividends from equities than those other sources. Then we have Social Security income. Most states, including California, do not tax Social Security. It's just taxable on the federal level, and somewhere between 0 and 85% of what you receive from Social Security is reportable as ordinary income on the federal level. So at worst case, federal, you'll get at least 15% of it tax-free on the federal side. And then lastly, Roth income, anything you have from a Roth is not taxable.
Now, one thing you do is a fee-based financial planner, which is very important because I'm thinking as you're talking, if I'm a commission-based or a financial planner that manages the money at the same time, I'm going to think, well, what hurts me the less if I sell this? Because if I lose that, I can't make commissions on that, or I can't make fees on it, well, I don't want to do that. What you look at is what's the best place for the client for tax reasons where to take the income from.
Exactly. So a lot of retirement's all about cash flow. You need cash flow to live. If you don't have wages coming in, you need to replace that. So structuring where your different income sources or your cash flow sources are coming from is how you live and be able to retire, but also make sure that you're paying the least amount of taxes as possible. So I don't sell anything. It's all about, well, how can we create the cash flow you need while, having the least amount of tax impact on that? And it's also important, not just in retirement, but when you're working. When you're working, understanding how your retirement income sources will be taxed will show you the types of things you should be investing in, the types of assets you should be buying, and the different types of accounts you should be using while you're in your accumulation phase, because the goal is to grow wealth efficiently and then be able to access that wealth efficiently through cash flow streams in retirement.
Yeah, and I think it's so important. I mean, you talk about understanding the different types of accounts, understanding the different types of investments. I do want to point out so people don't come after you as, muni bonds are obviously taxed different, treasury bonds are taxed different, but a lot of times people, you talk about like savings accounts, money market accounts, those are interests that they don't realize, corporate bonds, other types of bonds. So, I mean, there are different things, but obviously with muni bonds, I don't think those are great. I'm not advocating for them, but sometimes people point out like, oh, no, you're wrong.
That's another point that it's good to bring up because, the interest from municipal bonds are tax-free, not the capital gain. So if you do have gains on them, it's still treated as a capital gain, so that's taxable. But the interest is low. Now, generally, the interest that you get from muni bonds isn't very much. So in a lot of cases, it's better to get a higher yield and then pay a little bit of tax as opposed to, make no money and pay no tax.
Especially if you have no income.
So, I bring that up because a lot of people, might be able to invest in something that produces dividends or capital gains and still be in that 0% bracket where they just might naturally gravitate to the muni bonds, but, they'd be tax-free anyway, still with the capital gains. And then the T-bill interest, that's another one to bring up, Chase. Not taxable on the state level, but taxable at ordinary income rates on the federal level.
Yeah, so you live in Texas, Florida, it doesn't matter.
Right.
That's why people are moving there.
Yeah. And, one thing that always drives me crazy is when I see, totally off subject here, but when you see municipal bonds in retirement accounts, it's like, why would you do
that?
Yeah. And the smart person says, well, what idiot would do that? Unfortunately, we have seen brokers that get paid a commission do it, and it's just a terrible thing, but people have done it. Brokers have done it, and they just don't know what they're doing.
Yeah, I mean, do not do that. I mean, it's as simple as that.
And it's self-explanatory, but the reason you don't do this is because you get a lower interest rate in an account where there are no taxes.
Well,
so you don't get the tax benefit.
It is then taxable, though, because you earn interest, and then you withdraw that money, and then you pay taxes on the distribution. So it's creating a taxable event from something that should not be tax-free. Yeah.
Wow, somebody's really smart doing that. Aren't they? And again, so we're talking about it because sometimes you talk about things while they talk about it.
I've seen it from accounts that we've taken over.
Yeah, it does happen, and that's why we talk about it, because it does happen, which is crazy. And that's why, again, being a fee-based financial planner, you see these things with people, and you try to get them to a point to where they get the best retirement with the least amount of tax. And it's just, I don't know why somebody goes to a financial planner and they're not a fee-based planner. It's the craziest thing to do.
Well, I mean, if you don't know, but I mean, when I started here, I kind of just figured out that everybody hates taxes. So I spent a lot of time understanding how taxes work. And there's a lot of value that can be added by structuring everything correctly. Because again, I'm not incentivized to sell anything.
Yep, exactly. Well, that's why I brought you on board, because we knew as our firm was growing, we need to give people a good option. And I didn't want to bring on the normal financial planner. I'm going to bring on a fee-based financial planner that knows what he's talking about, knows taxes, no retirement, all these other things. So, well, Harrison, thank you very much. Some great information to make people smarter investors. If you want a free consultation with Harrison, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or you can contact him by email at the website smartinvesting2000.com. Again, that's smartinvesting2000.com. And maybe you just want a conversation with him, ask some questions. That's what he does. And again, he is not going to charge you commissions, fee-based. You get good, unbiased information.
He just gives advice. That's it.
Yeah, that's what he does.
That's his job.
And that's what you want. You want somebody that's unbiased there. So, all right. Let's move on and talk about this company here. People may not recognize the company, because when you told me Block, and that's BLOCK, like, who is Block? And it is
Square
Block, maybe? Where did Block come from?
I think I remember a few years ago they changed from Square to Block because Block was more encompassing. It's three-dimensional, where Square is on a flat plane. It is Jack Dorsey, the CEO there, that I think he's always trying to be outside the box.
Outside the box.
Yeah.
Outside the block.
Outside the square.
Outside the block. and I don't know how they got this symbol. I can't believe it was not used.
So funny.
XYZ. No one else had that, and they took XYZ.
Well, we always joke about it. It's like, we're looking at XYZ company here.
Yeah.
Don't go out and buy XYZ company. I didn't know there was an XYZ company.
We got to be
now
careful
we know.
now. Maybe we'll say buy XYZ company going forward. But Block is in the software infrastructure industry. Only 2.9% shares float. We do see 73% is institutional owned. PE ratio. Now, this is a good start. What surprised me, because I thought this was going to be a high flyer, but the PE ratio is 12.2. Well below the industry at 47.4, 0.6, I'm sorry. Price to sales 1.3 versus 9.4. Price to book value 1.4 versus 10.3. Price to cash flow is the only high one at 23.7 versus 26.7. But gosh, it's a great start here in the valuation ratios so far. Now, the earnings, and maybe things have turned for this company. Over the last year, their earnings are up 586%, well above the industry at 1.8%. Sales did climb only by 4.6%, slightly above the industry at 4.2%. They do not pay a dividend at this time. Maybe they will in the future. Look at the balance sheet. Nice current ratio, 2.3 versus 1.9. I like seeing this as well. Debt equity, only 0.3 versus 0.8. So a nice clean balance sheet you've got with Block. We do see a net profit margin, 10.9, which I think is pretty good, but the industry is at 21.8. So not sure why that is lower, but again, I'm not going to, say bad things about 11% profit margin. Return on equity is at 12.2, also below the industry at 30.2. We like about 15 or higher. Free cash flow is about 1.1 billion, where the industry is at 44 billion. So we do like free cash flow, something there, but let's talk about the company going forward.
Yeah, so current price, again, for Block, ticker symbol XYZ, $50.36. And you said, I thought this was a high flyer. It was. I mean, the 52-week high here, $99.26. Oh. But that doesn't even tell the full story. You go back to 2021, the stock hit an all-time high of $281.81 on August 5th, again, of 2021.
So this is, again, if you go back to Palantir, in the beginning of the show we talked about, here's another example.
Yeah, I mean, it's near its 52-week low now of 44.27. So, I mean, that hype has fizzled out. I remember Block years ago when it was Squared. It's all exciting. It was fintech. That was a big thing.
Fintech.
And, things kind of come and go. And, maybe there's opportunity here, because I go out to, I think they report on a calendar year. Let's just confirm that.
Wait, aren't you going to give the returns, past returns? Do you see them?
I'll let you give them since I already changed the page.
Yeah, I mean, year to date, down 41%. Yeah. Company's never made money. 5-year return, that's all they have. Negative 32%. So it's never made money. So if you bought this initially, do you know when it came out? the stock?
I believe it came out in like 2020 or something. 2009. Oh, it's confusing because obviously they changed from Square to Block.
Oh, okay. So that could be
they were Square was incorporated in 2009 and changed its name. It looks like to Block in 2021.
Okay, so
But I don't think the stock ever changed. So that stock information still goes back over history.
okay, yes.
I can kind of pull
But
it
it
up.
but it only gave a 5-year return, didn't give a 10-year return on those numbers. So maybe the symbol changed as well. Maybe we went to Block, they changed the symbol.
That is weird. Yeah, because mine goes back to 2015.
Oh,
So if on Seeking Alpha, if I go back to 2015, the stock was around $12. So if you bought it way back when, you're still up, but definitely fizzled out from the peak.
yeah.
But let's look at the numbers going forward here. As I said, maybe there's an opportunity. You go out to December 2026. I see estimated earnings per share of $4.05. Gives you a target sell price of $67.23. Estimated return here of about 33%. I mean, I'm going to say intriguing. And this business, I mean, I actually used a Square product for when I had my charity. I would use the little tapper, the insertion thing to kind of collect those mobile credit card payments. I thought it was a great company in terms of getting that done. And I was a very small scale, obviously, but you go to restaurants, you go to retail shops. I mean, you see the Square terminals pretty frequently, I would say.
Do they do anything else, do you know?
Yeah, I mean, this is kind of interesting, actually. They got a long laundry list here. They have banking services. They also have, I was kind of surprised by this, payroll services, marketing, gift cards. They also then have the Cash App, which is kind of like a competitor to Venmo. I don't really know anybody that uses Cash App personally. Most people I know use
heard of it.
Venmo. I used it, I remember, probably 5-6 years ago.
Right.
Actually, maybe even longer, but never used it then. But that actually includes peer-to-peer payments, obviously, Bitcoin and stock investment brokerage, tax preparation services. I was kind of surprised by that. And then this is another big one. I didn't know this, but they bought this company called Afterpay, which is a buy now, pay later service in January 2022 for, where's this number here? Gosh, $29 billion.
That's a lot of money. And I do worry about that industry because fine during the economy doing well, you got to slow down the economy. People are like, oh, sorry, I just can't pay it. And there's some issues with that. So I like the company. And I know Square is pretty big. Competitors?
I mean, the big one's going to be PayPal.
Yeah.
Big one's going to be PayPal. And then also, too, I mean, with the payments, it's not really a competitor with Apple Pay, I think, as much. I guess the buy now, pay later is. But I think they're more heavy on the merchant side. I think that's where a lot of the businesses come from. Just kind of based off visually looking, when you go to retail places, you see Square. I'm not sure how much comes from that. If a larger percent comes from collecting income from that portion of it, I'd be much more interested in this business. Yeah. I guess Toast is another one that would be a competitor in the restaurant space. But
yeah. I mean, I think there's something is here. And we always talk about when we invest in a company, there's a lot of research to do. 10, 15, 20 hours. It should take you weeks, not hours, before you make a decision on what to buy. I think you're right. There's something here, but I know we did have PayPal. We made some pretty good money off it, but we felt uncomfortable with it, hit its target sell price. We did get out of it, but we just didn't understand it. Didn't see people using PayPal. I do see people using Square.
more companies.
More companies.
Not people.
Well, right. I guess when you give the waiter your card, I think our car wash guy uses it as well. Give him the card, and he swipes it through his phone. Yep. So I guess that's Square. Yep. So, I think it's worth the research. And it is a fintech company. I don't hear that term anymore.
I think it's because it's not as popular. Now everything's about AI, not fintech.
Oh, that's right. Well, maybe there's an AI fintech company.
I'm sure there is.
So I guess what we're saying here is that, look at it. We're not saying it's a buy. There is potential here. But
I don't think we'll ever outright give you a buy on the show because of the amount of research it requires. But I'm going to say definitely worth more research.
Yes, I like that. So, all right. Well, let's move on to our next company here. I don't think, Chase, people are going to recognize this company. The company we're talking about is Amazon. So
I haven't heard of that one.
I wonder if there's anybody who's never heard of Amazon. I don't think there's a person in the U.S. that hasn't heard of it. Maybe if they're 5 years old.
Probably, yeah. I even then, my wife taught as a kindergarten teacher for years, and she said that kids knew like the smile of the Amazon truck. Really? It was branded so well that kids even then knew about Amazon.
Did they ask them if they knew about our logo, the W?
No, that was not.
We got to work hard on that. Okay.
I guess we need to get on more trucks.
More trucks. We'll put them on our cars.
They're in the car seats looking out, seeing the Amazon, I guess. I don't know.
All right, let's talk about Amazon, the numbers. They're symbol as AMZN. They're in the internet retail industry. And I think this is another great company, but we're going to look at the numbers here and see if it's worthwhile or not. Shares float only 0.7%. Nobody wants to go against this company currently. Only 65% institutional owned, which means a lot of individuals own Amazon. Now, we do see the PE ratio 31.4. That's just slightly above the industry at 29.1. Price to sales 3.2 versus 2.5. Price to book value 6.7 versus 4.9. Again, valuation ratios, you want them lower than the industry. Price to cash flow 18.2 versus 15.6. And a PEG ratio, which is a big positive, 1.1 versus 35.9, which means you're not paying very much at all for the future growth of this company. We do see the earnings over last year. Wow, up 72%. The industry is up 67.4%. So this is a growing industry. Sales are up 10.1%. That's double the industry at 5.3%. 5-year earnings per share growth estimate from the analysts is 29.1%. That is just blows away the industry estimate of 2.2. So Amazon doing great there. They still don't pay a dividend, which kind of surprised me. They've been around for a long time, still no dividend. Balance sheet, current ratio 1.1 versus 1.4. That's okay. Debt to equity 0.4 versus 0.5. I'll say they have a pretty good balance sheet in pretty good shape there. Net profit margin 10.1 versus 8.7. Return on equity 21.6 versus 21.1. Free cash flow, wow, a lot of free cash flow here, $20.8 billion. The industry is about $17 billion. So they generate a lot of free cash to do all these different things that they do with these, I can't even.
Amazon Web Services. I mean, that's really their
and
big
Bezos,
profit
he also does rockets.
Yeah, but that's not part of Amazon.
Oh, so he doesn't use the money from here to do that? That's his own personal thing?
I mean, yeah. It's not part of Amazon. Okay. He sells off his Amazon shares actually to do Blue Origin.
Oh, Blue Origin, that's the name.
Yeah, so I believe they are totally separate. Right. I mean, Amazon, they're big drivers. Talk about AWS. Their commerce business, obviously, I use it. I love Amazon. It's so funny. Years ago, we would talk smack about Amazon. I don't get it. Now I'm like, it's so easy.
You get toilet paper from there.
I get everything from Amazon. I get boxes coming all the time. It's so simple. I don't even go to Costco anymore. I don't go to Walmart. I don't go to Target.
What? You don't go to Costco?
Nope. Amazon's so easy. But obviously that commerce portion of the business, I don't think is where they make most of their money. It comes from AWS. And the big one that I think is interesting for Amazon is going to be the advertising component. I mean, obviously that Prime Video, I think they've really tried to start monetizing that via ads. And then also, too, I know if you're like on Amazon, you can kind of boost your search rating, kind of like almost like a Google type thing, I presume. So, I mean, I think that advertising business is growing nicely for them as well.
We participate for that. I mean, we do advertise. You'll see our commercials on Amazon, movies and TV shows and so forth. But I think it's only in Southern California.
It's only on Prime and Southern California.
Yep.
So, I mean, it's a great business, but looking at the numbers, current price here, $193.06. 52-week range, $151.61 is the low. The high here, $242.52. And I'll tell you, we talk about it being great business. This is one where I'd love to buy it. It's been a growth stock for so many years. At some point, I hope it transitions to a value stock. And I say I hope because it is still expensive. You go out to December 2026, estimated earnings per share is $7.26, gives us a target sell price of $120.52. So it's still pricey for us as value investors. But I will say, the 10-year return, very good for Amazon. I think it's over 800%. But the 5-year return is 60%. And that's still very good.
Right.
But I think it would surprise some people. Yeah. That's not as good as some other, well-known names during that time period. It's almost like Amazon is starting to kind of peter out here and go flat. Again, maybe we could pick this up in 2-3 years because I don't think this business is obviously going anywhere.
I agree with you. I would love to have this business. Great cash flow, great business, not going anywhere. It's just too expensive. And what we need is something to happen to have this business be mispriced. And they're like, we'll jump on this like crazy, but we're just not going to overpay for it because the growth isn't there. And again, we're not saying the stock is going to drop, but it just seems when you overpay for something, we've given you a couple examples today, that you're not going to do well going forward. So you want to buy things on sale. Right now, Amazon, it's not on sale yet. It's better than it was not too long ago.
Yeah, well, talking about value, maybe we should shift over to McDonald's and talk about their value meals.
Let's talk about McDonald's. I mean, I always hate talking about food companies because I get hungry. You know, I think about, but I got to say, I've not been in McDonald's, and I can't remember the last time. Do you go to McDonald's?
Last time I went was actually for Harrison's bachelor party. We were driving out to Yuma, Arizona, and stopped there on the way we were going to Phoenix. And gosh, that was about 2 years ago now. So It's been a while.
Well, let's talk about it a little bit more here. McDonald's, their symbol is MCD. They're in the restaurant industry. I'm surprised there's not a fast food restaurant industry, but they're just in the restaurant industry. Shares float on the short side, 1.6, 74% institutional owned. About 26% of people actually own that stock individually. It's probably been a great stock for them over the long term. PE ratio is high, 27.7, but the industry's, wow, 30.2. What's up with that? Price to sales, 8.7 versus 2.5. McDonald's has no price to book value, tangible or otherwise, and I think they have a lot of intangible assets on their balance
They're very
sheet.
asset light, like I was talking about earlier, where a lot of their restaurants are franchise owned, so they don't own the real estate, they don't own the assets. But I think they have a hefty marketing budget as well. Right. So it's interesting how they operate. I've never been comfortable, frankly, with the franchise-based model.
But I think they do own a lot of the restaurants too, though. I think they're one of the higher ones that does own them. But as you said, a lot probably is a franchise also. Price to cash flow, also high, 23.8 versus 1. PEG ratio, 2.6 versus 28.6. So that's a big positive. The earnings, here's the problem, down 3.2% over last year. The industry was down 1.2%, so McDonald's not doing as good as the industry. And the sales, gosh, people aren't going to McDonald's any longer. 0.6%, one-tenth the industry at 6.5%. We do see a 5-year earnings per share growth rate from the analysts of 9.5% versus 4.4%. They pay a dividend of a 2.3%, use about 59% of their earnings to pay that dividend out. They have paid that dividend for 10 plus consecutive years, so that is one thing you can count on from McDonald's to get that dividend. Look at the balance sheet, current ratio 1.2 versus 1.1. Debt to equity not material, I think, because, again, they have no equity because, as we talked about, the franchises and other things as well. We do see a net profit margin, wow, 31.7% versus 8.5%. You buy a Big Mac, or I think you like the Quarter Pounders, they're making about 31 cents off every dollar in that Quarter Pounder. That's pretty good profit margin. We do see return on equity, negative 216%. Return on invested capital is positive 20.2%. And again, I think it's partly because of franchise model. And again, we look at free cash flow, $6.6 billion of free cash coming in. They can do almost anything they want with, about double the industry at 3.9. So what do you got?
Yeah, so current price here for McDonald's, again, their ticker symbol MCD, $313.68. The 52-week range, the low here is $243.53, and the high is $326.32. And it is funny, I was kind of looking at the 5-year chart for McDonald's, up 72% over the last 5 years. So it's actually beaten Amazon. I think a lot of people would be surprised by that.
I'm surprised by that.
10-year return as well. I mean, it kind of blows me away, up about 220%. And
again, seeking alpha does not include the dividends.
No.
And this points out when we talk about we like to buy companies with dividends, how important they are. You add that dividend over the 10-year return, the 10-year return is 316%. I mean, that's almost 100% more.
Yeah, it's a huge benefit. Yeah. I mean, you've done very well in the stock. But the concern here going forward, out to December 2026, estimated earnings per share is $13.30. Gives it a target sell price is $220.78. I mean, it trades at nearly, I'm going to say, 24 times future earnings. It's very expensive. And the thing I'm shocked by, it kind of is reminiscent to me of Apple. We kind of hit on Apple pretty hard.
I was thinking Apple as well.
Because it's almost people are buying the name rather than buying the fundamentals of the business. And this is shocking. The most recent quarter had the largest decline in U.S. same-store sales since 2020. U.S. same-store sales, let's look at sales at all McDonald's locations that were open 1 year ago as well, were down 3.6%. They missed on sales at $5.96 billion, which is below the expectation at $6.09 billion. Why is this company up so much this year? I don't understand. I mean, it makes no sense to have, again, declining same-store sales, trading at nearly 24 times future earnings. It's puzzling. And, I mean, the estimated growth on earnings is mid to, I'm going to say, high single digits for this business.
And I think a problem with McDonald's, and we talk about the economy, we say the economy is pretty good, but it is weighted more towards being good on people that are above the average. McDonald's seems to have people on the lower income side. they have really pulled back quite a bit, and I don't see that turning around. I think that's what people see with McDonald's. I've held it for 10 years, made very good money. I'm not going to sell it. It's going to rebound back. But it's just sometimes they don't, and you got to be careful. And I think the economy, again, is fine, but I don't know about the lower ending income consumer who maybe have trouble a little bit longer and cut back on going to McDonald's.
And when you talk about the health movement, is that going to have an impact as well? People are going to be more concerned about it.
I did want to talk about that, but closing bell came too quick. So
Always comes too quick.
Too quickly. All right. Well, thank you for listening to Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great information there. You can sign up for the website. You can sign up for the newsletter, smartinvesting2000.com. Thanks for listening. We'll be back next week.